let's talk about what's happening with Kaynes Technology. What's the outlook on capacity addition, margin roadmap? Let's try and understand all about it with Ramesh Kannan. He's the MD at Kaynes, joining in on the show right now. Ramesh, hi, morning. Great to have you on the show. Tell me how the demand and the order inflows have been across your
Good morning to
underlying
you.
sectors, considering that Q4 is a strong quarter, and also what then is going to be the outlook in terms of high-growing segments in the next 2 years?
If you see in our electronic manufacturing service business, FY23 has been very good. More than 55% growth we have already clocked in. Profitability also has improved. Business verticals, if you see, I am able to see very steep growth in the industrial, automobile and EV. Thereafter, railways also there is good increase. Medical, aerospace and defense is something which is going very slow, but I'm sure and certain in the days to come and it is picking up.
Whom would you say in India is your nearest competitor, and what is your edge over your nearest competitor?
If you look at it, we do not have a competitor who are vertical-wise strong like us, but we have 3-4 players in each vertical. If you see, we have a listed company called SDS Sirma. We have a company called SFO in medical, like that. There are, for each verticals, we are a company with 5 strong verticals.
So why are your margins the best? And I was looking at margins of even, SGS Sirma. It's a listed company, so we have access to the margin. If I compare your margins versus their margin, you both are in almost the same business, but their margins are way below yours. Why is that?
I am unable to comment on theirs, but what I can tell you is we have a combination of, it's a combination of auto, defense, railways, aerospace, and medical. So all put together where the low volume, high tech, high mix is there. And this is what brings the extra margin. Our type of business where multiple changeovers are there, multiple values are there. So if you look at the comparison, you have to look at comparisons of companies of our type, which we do not have in that circle. We have no verticals more than 34. Our highest is 34, 35, which is auto. Then you have industrial, then we have railways, aerospace, no consumer electronics at all. In consumer, what's happened, it's a volume game. And that is where the margins are pulled down. I hope I have answered this.
What about the order execution rate? And of the total order book, which stands at 2,500 crore rupees, when will the orders flow into revenues and add on to your books?
See, for the next year order of around 1,700, 1,800 crores, we have 90+% of order confirmedly booked out of this 2,500. And for the coming years, orders have started coming in. Since we are a low volume, high tech, high mix company, we need orders visibility at least for 2 to 3 years, and which we are seeing.
You had also highlighted in your conference call in Q3 that you're in advanced stage of discussion with potential customers in China and Europe to close a large deal. What's the update on that front and how are things progressing? Can you share any details?
Things are progressing very good. Against China, what we need to do is we need to look at import substitutes. We need to look at more consumption in domestic, and then China replacement by global players. We are in talk with 1 or 2 players for this last, what I mentioned, China replacement. And I am very certain that one will come in. We should know in by first quarter of, our first audits are over. Our type of business acquisition takes almost 24 months. Execution takes another 12 months, and thereafter only building starts. So these are for the future.
So I'm going to put a time frame here. We are in 2023. Hypothetically, if we are having a similar conversation in 2028, that's 5 years, what kind of projected top line do you think we could be discussing? Today we are talking about a company. Yes, please.
I already mentioned in my last call, if you remember, we will be $1 billion plus. We have put our factory, we have done all arrangements for meeting this $1 billion plus. In fact, our company has embarked on new partnerships in technology front also to take this company to $1 billion plus, which is very, very important.
What a maths, and if I do a backward number, your FY23 number versus what you're telling us in 2028, you're looking at a growth of 20% plus on a CAGR basis for next 4 to 5 years. That's how maths works out.
You are right.
Okay.
And in our electronics business, what has happened is, one is the growth in the business. Second is more and more electromechanical and sensing technologies are getting converted into electronics. And that is where we are going to grow.
If I look at your revenue breakup, 38% is automotive. Large part is coming from railways. Walk us through these two verticals, because railways is dominated by government, automotive is dominated by private sector. Very different verticals.
Automotive, if you see, more and more EV growth is there, so more and more electronics is coming in. If you look at it, more and more global players are coming into India for getting the sub-assemblies manufactured. And I see 3 years back what was electromechanical or what was only a sensing is now getting into computing as well as getting into electronics. So more and more electronics coming on each vehicle. When it comes to railway, we are in the signaling business. We are also in the traction business. In signaling business, I find there is a big growth in India because a lot of infrastructure is coming in, and I am sure and certain, and that is where our growth is happening. Government spending is increasing on safety grounds, and that is where signaling and high-speed vehicles are also coming in. So this current signaling will not work for that. My customers are giving us newer opportunities to get into the next level of signaling.
Do you think you can take your margins closer to 20% as operating leverage kicks in, or it's going to be a difficult one? I mean, as progressively.
It will be only at 15 plus.
Okay, so
it cannot be 20.
So if I have to construct the next 4 to 5 year kind of a big picture for Kaynes Technology, what you're sharing with us is that you see a definite growth of 20% plus for next 4 to 5 years on a CAGR basis, and you think margins will be between 13 to 15%. They're not going to go lower, they may not go higher, but they will remain in a 13 to 15% band.
You are right, your inference is right, because we are able to clearly see a 3 years visibility, and from there onwards we are started working towards customers coming into larger size. So that is where my $1 billion dream will come true.
This optimism, I mean, with all due respect, that business environment is uncertain, could remain uncertain, and could turn even more uncertain. What looks like clear right now could be foggy. What is the biggest impediment? What could challenge your optimism?
It is a political turmoil should not happen. Geopolitics should not play in. Otherwise, I think because we are in a space where more growth is happening. We are in a space where more automation is happening, more computing is getting in. So since we are in that space, I feel no other challenge can happen. Plus, internally to grow, I keep telling my team, for us to grow, we need to do the work. Whereas our neighboring countries like Malaysia or Indonesia or Thailand, they could grow. They had already infrastructures, technologies, and some favoring rules with them. So in our case, we need to do that marketing side.
Thank you for joining in, Mr. Kannan, and giving us a view on how business is shaping up. With the markets